All right, so today we actually have a few topics that we're going to cover. So overall, and what we're going to end up getting to is the exposures and basically how to see the bigger picture in the market. But before we get to that, I do want to start off with unusual options. So a lot of people, when they get into options, are looking for a quick strategy or a strategy that ultimately makes a lot of sense to them. And the first thing that we really see is kind of the concept of following the money. So this entire ideology that if we see large money in the market, that we're able to simply copy what that money is doing and replicate results, right? So we kind of move through a few different stages as traders. I like to think about the first stage as simply being able to do your entire trading off of a couple of horizontal lines to your support and resistance. And then we kind of realize that that's not capturing the entirety of the market. So we look for something else that makes sense. The next phase for that is usually external data that we then try and apply to our trading, which would then be this unusual options side of things, right? So taking something that actually is information, and it's not something like, oh, this line looks like it's touching a bunch of candles, and trying to leverage that in our trading. So taking that and being like, oh, well, there's $100,000 in this Tesla trade. So if we're just looking at the screen, this first one at the top, and then trying to base your trades solely off of that information, right? It's another data point that we don't really get from our brokerage. So it's not something that you're able to see on your Thinkorswim or your IBKR quite like this. And it is just a different dimension of the market. So what do we actually think about when we're thinking about the term unusual? So the thing is, when we're trying to utilize a data point like this, is that there isn't really a definitive or a tried and true methodology of what we would consider to be unusual, right? The two ways that we look at this normally are overall order size, so the number of contracts that are being traded around, and then the value of this. So because there's no real definition, and we'll get into this later, I feel like unusual options do not necessarily provide the smartest or most intelligent information when we're thinking about entering a trade. So it's like, let's go to this. Let's start this so everybody can still see the screen, it looks like. So when we're looking at unusual options, and this is through the TraderLink dashboard. So right now we just have the unusual options component up. We're presented with obviously the basics of information. We know what the ticker is. We know that the strike is 255 in this case. We know the mark. So this is the underlying price. So this means that Tesla was trading at 257.15 when this order was filled. We know the expiration dates. This is actually expiring tomorrow. A lot of these orders for Tesla are actually tomorrow expo. We know the value, the fill, right? So what they actually were bought and sold at, and the total number of contracts that were kind of exchanged hands. On top of that, we have a few things that help us better understand what the context is of this trade overall. So the sentiment, we have this as just where the value of the trade is in relation to the current mark. So every time that we have a trade, we have a bid and we have an ask. When people buy over the ask, usually that means that they're in a rush to purchase something, which we quantify as like buy predominant. Which is the opposite of it. They're trying to just get rid of something under the bid. That means that they're in a rush to sell. So that would be a sell predominant. So that's why it kind of is quantified in this green and red. And then we are looking at, I know a lot of people when they're trading based solely off options, they're looking for the volume of the contracts and the number of contracts being traded to be larger than the previous days of open interest. This is usually just utilized to show that there is liquidity in the contract, that people actually care about what's being traded. You never want to trade a contract that has no volume, because if you buy it, even if you can get it for dirt cheap, the odds of you being able to get out are slim to none. There's no volume, nobody's moving these contracts around, which means that even if you get them, you also will probably not be able to move them around. And then out of the money or in the money. So in this case, we have Tesla 255 put. We are currently trading over that when this is purchased. That means that this is out of the money, right? So it would need to be higher than 257 to actually be in the money in this case. So we're trying to take this and we're trying to quantify what is important from what isn't important, right? So we can look at the value and arbitrarily say, hey, something with a large value is important, but that's not always true. And then we could say something with a large contract size is important, and that's not necessarily true, because when we start going through, and let's just pull this back up. When we start going through this and we're trying to utilize unusual options by itself to make these decisions, we kind of come across this next concept that as traders were approached with, right? And that is that institutions and market makers rarely take one-sided positions. So when we're looking at this and we're on TraderLink, or you're using Flow Algo, or whatever you're using to check your unusual options flow, or your FinTwit, or whoever's showing it to you, the idea in my mind of looking at one contract that is super big and then basing your trading solely off of the fact that a lot of money was moved there does not make a lot of sense to me, because institutions and market makers like to do what we call hedging, right? So even though there's a lot of money exchanged in one individual position, oftentimes they have other money in something else that is kind of balancing out their risk. So it's like when we start trading, we're like, oh, I'm in calls, right? But if you're just in calls and that goes to zero, you lose all your money. So a market maker doesn't like to lose all their money, because it's often, other investors, and they get pissed off at that. So they would take, let's say, a call and also a put, or some other variation to protect themselves. So if it doesn't go the way that they're looking for initially, they don't lose all of their money. They might lose some money still, but they don't blow the entire portfolio off one trade. So if we're trying to use unusual options to dictate the entire market and get the bigger picture, we can't really do that. We don't necessarily know what the other side of these trades is. We don't know if, like, oh, if they're just taking Tesla calls, that they're then also in Tesla puts. They could be in any other financial instrument that's out there. It could be stock, and they could be taking options against it. You don't know. So I think that unusual options is actually a cool thing to look at, but it doesn't really provide a picture of the market that we need to look at to make decisions, right? If we see a bunch of money going into Tesla in the unusual options chain, it doesn't necessarily mean that you should be diving in and doing that. So this kind of brings the question, which Sheen and Geo are going to answer here. It's like, so what can we look at that gives us a bigger section of the market? What actually gives us that full picture? And this is kind of where we start to go into exposures. So this is based off of the options, and I will let them dig into that. Sheen, you still have screen sharing, right?
Let me check. Oh yeah, it'll stop it, so I'm good.
How
I
do I
think
get
Gio's
screen
gonna
share?
screen share.
Yeah, how do I get screen share?
You should be co-host, so you should be able to just get in. No?
Let's see. Stop participant sharing.
Yep, I'll stop mine.
All right, cool. Here we go. Okay, can you see this blank page?
Yeah.
Can you see the annotations?
Yep.
All right, cool. So, getting into this, I wanted to start off by explaining dynamic hedging, or delta hedging actually. So, basically how this can I guess help you get a better understanding of gamma exposure. I promise it'll all make sense towards the end. But in order to build a strong foundation of gamma, Vana, and charm, you kind of need to know these things about the dynamics of hedging. So let's say market maker buys one call option. So this call option has a 60 delta, we'll give it, so 0.6 delta. Now this one call option with the 60 delta, it's 60 because 0.6, and then since you're dealing with options, you multiply it by 100. This gets you 60 delta Greek. And now that you have this, or the market dealer has a 60 delta, automatically they need to go delta neutral, right? So this is the number they're trying to get, 0. Now in order to do that, he can do one of two things. He could short sell 60 shares. So negative 60 shares. Or he could buy a short option, long put short call, with equally negative 0.6 delta, which would give you your 0 delta total. Now this is the basics of dynamic hedging. Now, this is where we're going to start making our money, right? So let's say the 0 goes to 0.1 or negative 0.1. Now he's off by 10 shares. So he either needs to buy back 10 shares or sell off 10 shares in either of these instances. And these instances only happen on a 1% move of the, we'll use SPX in this case. SPX is underlying. So if there's a 1% move in the underlying, now he needs to rehedge all of this delta. We make money by buying shares or selling shares with them. So this is where you get your, crazy 10, 20 point moves. Once we get to a high sensitive area of interest on the gamma exposure charts. So basically the whole preface of this strategy is to know when they go over 0 or under 0. And that's kind of the basis of it. But very minimal numbers. Now if you were to multiply these call options by, I don't know, let's say they buy 1,000 call options. Now you multiply every number by 1,000 and 1,000, 10,000, 20, 200,000 shares of SPY can have a very large effect on the market. And this is all just exploiting the one property that all hedge funds are built on: risk management. Every single fund is based on managing their risk. Every time they buy an asset, they need to offset it by buying or selling another asset. For in a quick example, I don't know how familiar you guys are with the JPM collar, right, where they pour in billions of dollars into a straddle of options. Those options are used to be the tail risk hedge for their long equities ETF. I think it's called JHEX or something. But yeah, this long ETF gets hedged by their option strategy. So just to shed some light on that. But I'm gonna stop sharing. I'm gonna have Sheen share while he controls my my slides.
All right, you're good to go.
All right. So let's see. So getting into gamma exposure and what gamma exposure is, positive gamma exposure. We'll separate it off into sections because it's a lot easier to understand positive and negative versus the granularity of it. So positive gamma exposure for long options like long calls or short puts, the delta becomes increasingly positive as the underlying moves up. Vice versa for negative gamma and options that hold a negative delta. An example for this is short options like long puts or short calls. Now, some tips when looking at gamma exposure. The high gamma exposure sensitivity on the chart leads to rapid delta changes whenever the price moves up or down. This causes the frequent rehedging, important keyword there, because this is where you use the tool to make all of your money. You're always trying to catch a ride on the second move, not the first move. That makes sense when we'll get into the further slides. Next slide. So getting into positive gamma exposure, you'll start to see a pattern as we move through the slides. This is all just the basics, which is enough to make you guys money using the exposures. But just so you know, we can go a lot further in depth. I answer a lot of questions in the Discord. If you guys have any questions on stuff like this, I go into the math if you care for that. But I could honestly host a class every single day for a month and still not get through a lot of the different exposures. There's about 14 or so. If we start getting into the math portions and the psychology portions of it all. So this is just to get you guys versed enough to make money using the different exposures. But for example, right, in a positive gamma exposure environment, when the underlying asset is below strike prices where there's a high positive gamma exposure, any downward move that the asset has will reduce the delta of those options. So to maintain being delta neutral, market makers need to sell the underlying asset, hence putting downward pressure on the asset, But as the asset starts to fall, the delta reduction diminishes, right? As we move past that strike, meaning fewer sales are needed. This acts as a floor for the market, or you could see it as a support. And as we move through these slides, you'll start to notice a pattern with gamma being similar to floors and tops of the market, Vana exposure having a magnetizing effect on the market, and charm exposure having something like I look towards charm exposure to get a sentiment of the market. Is it bullish, is it bearish type of deal. Now getting into positive gamma exposure over spot price. When the underlying asset rises and approaches strike prices with a high positive gamma exposure, the delta of these options starts to increase. Now to hedge, market makers have to buy more of these assets. However, as the assets continue to rise and go beyond these strike prices, the increase in delta starts to slow down, meaning market makers are going to start buying less. This acts as a resistance. So in the image right here, right, if spot price, the gray line in the middle of the screen, as we start moving up and up, 4470, 4460, 4490, these the positive gamma exposure is going to start acting as a resistance for the market. And this is where your opportunity to start developing a short position. Typically, you want to start your position where the highest sensitivity is. So as we move further up, you'll start seeing higher sensitivities make their way. But getting into the
Did Gio's mic cut out?
hello,
There you
sorry,
go.
I think
Okay.
my Wi-Fi went out.
All good.
So going into negative gamma exposure under spot price, this typically refers to short options positions. So when the asset starts to fall, the negative gamma means that the absolute delta on these options starts to increase. This requires market makers to start buying the asset to hedge and providing support. So there's different instances where there's supports and resistances, and kind of finding the idea on the gamma exposure chart, Vana exposure chart, and charm exposure chart. Having all three line up typically gives you an idea of, hey, I should probably start going along here. People in the Discord that have been here for a while see that we're trying to catch 40, 50 point moves, and profiting largely off of them. So in the next slide, you're gonna start seeing an example of this is relatively I think, oh yeah, this is on the 19th, so it was only a couple days ago. You can see here off of the last slide, there is an example, negative gamma exposure below spot price. On the chart to the left, the blue graph chart, you see the negative gamma exposure directly underneath spot price. Now there's two ways you could have played this, right? You could have seen that and been like, okay, so as we start moving towards the highest exposure, I could buy puts, right? And then as we start getting bottoming out, this is the area where we use gamma exposure as support, or the rehedging mechanic. So you could have went long as we started moving towards the highest sensitivity possible. This is just one method to use it. Again, there's various others, but this is the most cut and dry, I think. Now getting into the negative gamma exposure over spot price. As the asset rises beyond these types of strike prices, again, all the strike prices are highlighted. This example, typically, you want to see a higher negative gamma exposure for the sake of the example, though. This is the only one I could find recently. So typically you want that bar to be a lot bigger, but as the asset price rises beyond these strike prices, the absolute delta on the short options position starts to decrease, meaning market makers need to sell the asset to maintain their delta neutral stance, providing resistance for the market. So as you can see, market makers and market dealers that provide liquidity to the market tend to either compress volatility or expand volatility, making sort of like a manipulation effect on the market. I hate to use that word, but I mean, you know, they're just trying to protect themselves. They personally don't care whether or not the stock price goes up or down. It's really just a matter of managing their own positions. Sorry, let me take a sip of water here. But this is generally the basis of gamma exposure. There's again, you can ask me questions about this in the Discord. I answer them pretty regularly. But I also plan on making a few newer calculations for the gamma exposure. If you don't know already, I'm sort of the math guy. Um, that's why I'm not the best at public speaking. But getting into the further exposures like Vana exposure. Um, let's see what we got. So yeah, so everyone and their mother seems to understand what gamma exposure is, right? What is Vana exposure though? Well, that's the sensitivity of the options position to changes in the underlying asset price, and the changes of the implied volatility. This is a keyword because this is what differentiates it from any other type of exposure, the implied volatility aspect. Now, measuring that rate of change of the options delta with respect to both the underlying price changes and the implied volatility. So now we're getting two sections of it, right? The underlying asset price move with gamma exposure and implied volatilities movement with Vana exposure. This helps us understand how a portfolio may need to be hedged based on these changes in the volatility. If things get too volatile and price starts to swing up and down, market dealers and market makers need to rehedge those balances based on that. So how this can be used in real life opportunity, something similar to FOMC, right? When there's heightened volatility and you can expect IV crush to happen at some point in the day, you can bet that volatility is not going to be as high as it is currently and make trading decisions based on that, right? Are they going to need to hedge based on the high volatility? Are they going to be able to, or are they going to need to rehedge based on the low volatility? I've been asked over and over again in the Discord, how do you have a concept of what's going to happen on news days before they actually happen? This is how volatility kind of is a decider in that factor. Now, for portfolios that are delta neutral, Vana becomes particularly important during periods of significant volatility shifts. So typically only these Fed days or the week leading into OPEX, you're going to want to be pointing your attentions toward Vana and Charm. And the weeks, beginning week of the month and last week of the month, typically I like to use gamma exposure more independently. Now, this basically is going to indicate how much adjustment for the portfolio is going to be needed to maintain that type of neutrality, right? I know there were some questions I saw yesterday about the BN number at the top of the graphs. That's BN stands for billion, if you didn't know. So the number up there is the amount of delta that needs to be purchased or sold based on the 1% move of the underlying asset. Now getting into positive gamma exposure. So this is positive gamma exposure under spot price. I don't know if you've sensed the pattern yet, but typically I'm just going to be explaining what you should expect if a certain amount of exposure is below or above spot price and how you need to proceed once visualizing that. Similarly, when the underlying is above the strike price with a high positive Vana exposure, a rise in implied volatility is also going to lead to an increase in the delta of that option. Now, to remain delta neutral, market makers are going to need to buy more of the underlying asset, exerting upward pressure on its price. This can act as a sort of pulling mechanism for the underlying, meaning if they push too far up, the negative Vana exposure below spot price starts pulling price down. And that's you can think of Vana exposure as a sort of rubber band, right? You pull it too much, eventually when you let go of the end, it snaps back. And that's typically how I go about Vana exposure. I like giving some realistic ideas to it. But getting into positive Vana exposure, when the underlying assets price is below the strike price with a high positive Vana exposure, any increase in implied volatility is going to lead to an increase in the delta of an option. So as IV rises, market makers who are typically going to be already delta neutral are going to need to start buying the underlying asset to hedge based on the increase in the delta. The buying pressure can pull the asset upwards towards these types of strikes. So like the spot price being underneath the positive Vana exposure in an instant like this can start pulling it towards if there's enough positive Vana exposure above spot price, can start pulling it towards those higher strikes. Now this can often be confused with the effect on gamma, right? People think gamma is the magnet when in fact it's Vana exposure having that magnetizing effect. But gamma exposure is the decider based on when these things need to be rehedged, right? And based on the number at the very top of the graph, you can go, there's going to be very different numbers for every single exposure. Typically, the one with the largest number is going to need the most rehedging. But going into the next negative Vana exposure under spot price, when the underlying asset is above strike prices with a high negative Vana exposure, an increase in the IV will also lead to a decrease in the delta exposure, making market makers sell the underlying to hedge. This selling pressure can push the underlying asset price down, acting as a reversion mechanism, right? So as we move towards these strikes, it'll start to repel the price back up. Let's see. And then we got, I think, one more instance of Vana exposure. Sorry, I'm caught in mouth over here. So negative Vana exposure over spot price. When the asset's price is below the strike, or when the asset's price is below the strike price with a high negative Vana exposure, an increase in implied volatility is going to change the delta of that option again. And this is going to need to force market makers to sell the underlying asset. And as price continues to fall away from these strike prices that have the highest exposure, the ones highlighted in the graph, it starts pulling back price towards those strike prices. So again, another type of reversion tactic. The further we pull away, the stronger the snapback is going to be in a sense. I don't know if some of you are familiar with Chem Garçon. He talks about things like that very in depth. But now getting into charm exposure, this type of exposure is unique in a way because I don't exactly use it to find these types of rehedging mechanics because you can use it. That's not to say you can't. There is such a thing as a charm rally, for instance, right? Now very particular on the days of charm rallies. But I typically use it to get a market sentiment for the day, right? Is the day bullish? Is the day bearish? Based on these different charm flows. So charm measures the rate of change in an option's delta with respect to time. This is fairly confusing for people because they always relate charm to theta when in fact the two are very different. So theta measures the rate at which an option's price decreases over time, expressed per day, right? Charm measures the rate at which an option's delta changes over time, also expressed per day. So theta is about price decay, while charm is more about the directional exposure of delta and how that changes as time passes on. So very big difference, even though the words don't exactly seem so, I guess. But getting into a positive charm exposure under spot price more particular, if there's positive charm exposure below spot price, the deltas of the options under spot price are going to increase as well. For calls, the delta becomes more positive, and for puts, it becomes less negative. Now, to hedge, market makers would need to sell the underlying asset. This places downward pressure on price. So typically, if I see this, I'm expecting there to be a fairly bearish price action on the day. And this can influence your types of trades, right? If I look at charm exposure on the day and I'm like, okay, is it bearish or bullish? Should I be looking for calls or puts, essentially, right? And based on charm exposure, I get to formulate a plan of action on the day. Am I only looking for calls? Am I only looking for puts? Because typically, if there's bearish price action on the day, you don't really want to be forced to look for calls. And this gives you an idea of that, of what to expect on the day. Now getting into positive charm exposure over spot price. If there's positive charm exposure over the current spot price, it means that as time passes, the delta of these options starts to increase. In context, for call options, the delta becomes more positive, and for put options, the delta becomes less negative. If market makers are going to start to become delta neutral, they need to adjust their hedging positions by in response to the changing of the deltas, right? So specifically, they'll be selling the underlying asset, which introduces bearish pressure on the asset's price. Again, another bear scenario. But now getting into negative charm exposure under spot price. With negative charm exposure below the spot price, the deltas of these options start to decrease. The deltas for calls become less positive, and for puts, it becomes more negative. Now, to hedge, they would need to buy the underlying asset because they need to think of it like a seesaw, right? They're trying to balance the seesaw continuously. This adds upward pressure on the market, making, if you were to look at this per se charm exposure, as soon as you open, your trader link dashboard, okay, bullish price action on the dashboard. Now look to gamma exposure to find a proper rehedging mechanic to capture, a play for calls or something of that sort. So understanding these flows kind of tells you what not to do, what to do, I guess, on the day. Getting into negative charm exposure over spot price. With negative charm exposure above spot price, the deltas of these options start to decrease over time. So as the delta becomes less positive, and for put options, it becomes more negative. To remain delta neutral, market makers need to buy the underlying asset. Again, introducing more bullish pressure on the market. Typically, if you're looking, 30 days out on this chart, for example, you as the days continuously tick on by, up until like I would say the week before OPEX, you would start using charm exposure and basing trades off of these types of assumptions, right? You have to kind of take it with a grain of salt, off of the beginning months and the end, or beginning of the week and end of the month. Beginning of the month, end of the month, sorry. But again, you guys can, this is all recorded, so you can pause it, take a look at the slides on YouTube, formulate some questions, post them in Discord, and I'll answer them to the best of my ability. We got more calculations also too, I know a lot of you saw that summary module. That's kind of our way of taking out all the hard work for you guys and trying to visualize the market based on that one module, taking trades based on that. So we're trying our best to devise a correct standard of reading everything. So for the people that don't understand a word I just said, they can look to that module and still make money based on those trades. So you let us do the nerd work and you guys can profit, unless you're just curious on the math and stuff. But yeah, other than that, I think Sheen's gonna go into speed exposure next.
Alrighty. Seems like this is the tool that everyone would like to learn. It's Hassan's favorite tool. So let's get into it. What is speed exposure? So speed exposure is the D gamma and D spot. That's the formula for it. But what it actually measures is the rate of change of gamma, which is the rate of change of an option's delta. So it is essentially the gamma of gamma per se. That's something that we kind of just say to try to get people to understand it. So it measures the rate of change of gamma with respect to changes in the underlying asset's price, right? So it's kind of just measuring the rate of change of an option's delta truly, the simplest version of it. It indicates whether or not an option's delta will have an increase in acceleration or deceleration of the delta as the underlying asset's price moves. So simply put, it measures how quickly the option's delta changes in response to changes in the underlying asset's price, right? So if the stock goes up, it'll basically measure how quickly the delta is going to increase or decrease per se. Positive speed exposure. What is it, right? You see us say positive and negative all the time with every single exposure, but for positive speed exposure for this instance, it indicates that the option's gamma is increasing as the underlying asset's price moves. With that being said, the delta is becoming more and more sensitive to changes in the underlying asset's price, potentially resulting in larger gains or larger losses, right? So as you can tell with the picture here, this is positive speed exposure. The strike prices with the highest exposure or the highest positive speed exposures will have the most acceleration in the delta, meaning if you're looking to go long, this is typically what you want to pick. You want to pick between these contracts, right? So that's typically how we kind of visualize it. It's more so meant to basically give you the contract with the best potential for gains. Negative speed exposure. Negative speed exposure indicates that the options gamma is decreasing as the underlying asset's price moves. So what does that mean? The delta is becoming less sensitive to changes in the underlying asset's price. So as the stock moves up, a good way to think about it is, let's say you're looking to go long, however, you see these negative speed exposures. Those are not the contracts you want to look for when you go long. Because why? Because the delta is very, very insensitive. So it's constantly going to be moving a lot. It's going to be moving a lot slower than per se if you were to pick these, right? So that's kind of a good way to think about it. So this is an analogy that I came up with, and we use it all the time now for a visualization of it, right? So picture a rock rolling down a hill. The delta is the rock, and the speed exposure is the slope of the hill, right? So the steeper the slope, obviously, the faster the rock can actually roll down, right? Does that make sense to everyone? I feel like that's relatively simple. So put it together now, you have the steeper the slope equals the higher the positive speed exposure, right? The faster the rock rolls down the hill, the faster the delta can accelerate, right? So the faster the delta can increase. Now vice versa. The flatter the slope, obviously the rock doesn't roll as fast, right? So it's not going to be able to accelerate as quick if the slope is flatter. So negative speed exposure equals the slower acceleration in the delta of the option. Hopefully that makes sense. Simply put, we use this, like I said earlier, we use this to pick the contract that we want to enter when we take a position. It's super useful. Once again, this is just a simple way to amplify the gains when utilizing speed exposure, right? So conclusion, speed exposure, excuse me. Conclusion, speed exposure can be used in a multitude of ways. However, we believe that it is the most optimal way to use it is contract selection, as I said, since it shows how fast the delta of a contract can accelerate. It gives us insight into which contract will actually just move the best. If the stock goes the way, obviously, that you're anticipating, speed exposure's contract selection can help you capitalize on the move even more so than usual. All right, for everyone, we always constantly get questions on when we say buy or sell, or if it's a split buy sell or sell buy, right? Let's get into it. I've broken it down to the absolute most basic way, with two different ways to visualize it and read it. So hopefully this is a good way for you guys to understand it. This is the cheat sheet, right? This is what, Gio and I have created a long time ago when we first started. This is essentially how you can visualize and get some form of a bias for the day, right? So for example, if it leads to a buy, I'm looking for longs. If it leads to a sell, I'm looking for shorts on the day. If it leads to a buy sell, I'm not even bothering looking for the day, right? So this is a great way for people to sort of make that bias decision of what am I looking at, instead of just waiting for candles. You see a big spike up, you buy. You see a big spike down, you sell, right? Or you go short. It's a good way for people to also maintain some form of like not having to trade every day, right? Because a lot of people get kind of confused, or they get this anxiety to want to trade every day and try to make money. But if anyone here can tell you, it's just like, you don't have to trade every day. Trade on the days that are the absolute best days to trade, right? And this is just a good way to kind of get started on the day on deciding whether or not you want to take a position. So getting into it, step number one is identify the environment. How? You want to identify whether or not gamma exposure is positive or negative, and it is squared right here with an arrow pointing at it, so you cannot miss it. This is how. So in this case, gamma exposure is negative, right? Step one is complete. For the cheat sheet, we'll go back a slide. So we kind of identified, okay, gamma exposure is negative. Next one. Step two is also simple. Identify the highest exposure, or the AOI as we call it, the area of interest, right? This is the highest exposure. As you can tell, I have put a rectangle around it and an arrow. You can't miss it. All right, we've labeled it the AOI. 4475 is the AOI in this case specifically. Next one, step three is where it gets slightly tougher and a little bit more confusing, right? So you want to identify the potential. So before deciding the actual hedging requirement, we need to look at both the bullish and bearish scenarios that the market is actually capable of, right? So i.e., what happens if the market goes up, or what happens if the market goes down? This is the next section, right? Underlying price movement. What happens if the market increases? What happens if the market decreases, right? So you kind of just want to go column by column after identifying positive, negative, what is the AOI? So by reading into both potential moves, we're able to understand the overall market potential, right? This is where we get into, is it a buy? Am I looking for longs for the day? Am I looking for shorts for the day? Or am I just not trading? So step three breakdown, identify the potential. What happens to the AOI's volatility as the underlying asset price increases and decreases, right? So in the picture to the right, we'll identify the increase scenario first. Again, I've highlighted the AOI, right? I want you guys to focus on this part. This is important because a lot of people get this confused when it's a very, very simple concept, right? You want to identify what happens to the AOI's volatility, right? So in this case, on the picture on the right, we're identifying the increase scenario. So the gray arrow shows the underlying asset price is increasing, correct? This gray arrow right here, as you can tell, the spot price moves over to the right of the chart. It increases in price. The gold arrow shows the volatility on the AOI increasing, correct? So once the spot price increases, the AOI shifts to the left side of the screen per se, right? It follows the left side of the volatility skew. And with that being said, the other way to visualize it is the 44.75 AOI or strike price gets closer and closer at the money as the stock price moves up, correct? The other way, like I said, the AOI is moving to the left side of the volatility skew, as you can tell. So what does this mean? The underlying asset is increasing and the volatility is increasing, right? Now, onto this the next part of the step three breakdown is in the picture to the right, we will identify the decrease scenario now, right? It's just the opposite. Use the AOI and it's the opposite, right? So the spot price or the underlying asset price decreases, right? The gray arrow shows the asset decreasing. Gold arrow shows the volatility on the AOI decreasing up until a certain point. Obviously, that's a thing to get into for a different time, but overall, just short-term wise, it is decreasing, right? So the gold arrow shows the volatility on the AOI decreasing. Other way to visualize it now, right? The 44.75 AOI / strike price gets further and further out the money, right? Per se, this is a call, right? If it's a 44.75 call and the underlying asset price, say SPX in this case specifically, decreases, what happens to the call? It gets further and further out the money, right? That's very simple. Everyone should know that, right? So now what do we come down to? Underlying asset is decreasing and the volatility is also decreasing with it. Now let's combine it, the hedging requirement. So as we broke down, combine the information, and on the cheat sheet, once again, I'm just going to go over step one, step two, step three. We identified the environment, which is negative for gamma exposure. We identified both situations where the underlying asset is increasing, the volatility at the AOI increases, right? Then you follow the columns. Guess what? Next one is the hedging requirement is sell stock. Next step, underlying asset decreases, volatility at the AOI decreases as I showed you, and you get to the next bias of sell stock, right? So now that you have a double sell stock as the hedging requirement, this info can give you a bearish outlook on what to take for the day, right? There's so many instances where people come into the market and they're like, shit, what do I take for the day? Am I going to go long at this support? Am I going to go short at the support and whatnot? With this, it can help you determine, this is at least what I use literally on a daily basis, guys. This is not something where, once again, we're not showing you things that we don't use. This is just, Geo has his way, as he showed you with gamma exposure, Vana exposure, and charm. This is just another way to utilize gamma exposure, right? And this is something that I use on a daily basis, as I said. So once you have a double sell, next one is the conclusion, right? There are multiple different ways to utilize it, as I have said, whether that's in combination with the knowledge and understanding of the other exposures as Geo utilizes it, or basic levels to watch for the day as majority of people utilize it, or through the cheat sheet bias. So I'm not going to tell you this is the only way to use it. You have to use it this way. But pick a way that fits your trading style, right? I showed Mitchell, I showed Hassan. I don't utilize it to find exact entries or exits. I mix it into what I already know. So if you have a strategy to find your entries or your exits, great, utilize that, right? But implement this into it. So if your entry signal or whatever strategy for your entries tells you to go long, confirm it with a buy. If it's a buy, great, fantastic. You have multiple things lined up, right? If it's a sell, then you don't, right? It's just adding extra things, because conviction is like one of the only weapons or tools that we truly have as traders when we're actually executing. So when you have a full-on conviction, it helps. So that's it, Mitchell.
I was gonna start talking, but my mic isn't on. So, like I was saying in the chat, everybody like seeing this for the very first time. It is a lot of information. So a lot of these exposures. So myself personally, I've been using this for a significantly shorter amount of time than both Geo and Sheen. In my actual trading, I think I'm probably using Gamma. So literally just the very first one that they went over today. And even understanding that and understanding a few of the other ones in application has made my trading significantly better, right? I've gotten a lot better at avoiding days where you're going to have chop. If the actual options contracts themselves are telling you that there's, some uncertainty, you can just avoid those days altogether. So at first glance, it definitely sounds like a lot of information. And without seeing it live, it is kind of difficult to visualize how those are actually moving along throughout the day. So tomorrow, I don't know if we have a set time for the live analysis. I think that it makes more sense to do it. Like I don't really trade at market open anyway. So I'm saying like maybe 8 PST. So what's that, 11 Eastern time? Probably be a good time to start and just give people a live view of the dashboard with somebody charting side by side so we can kind of explain what we're seeing. It's one of those things that like as you do it more, it makes more sense. You're not going to grasp these concepts just by reading about them. You need to actually put them into application, stare at them while you're trading, and kind of build that understanding of how it moves in relation to the underlying price action. So I think tomorrow is kind of what's going to bring all of this full circle, seeing the dashboard, seeing the time and sales, seeing the gamma and the other exposures with the market movement, right? So that's gonna be the last day for this masterclass. So if you do have any questions, and I know that this is going to be the most question-driven session, drop them in the questions channel and we'll get back to them, and then people can revisit that if they have the same question. Don't feel bad if you do not understand this entirely right now. This is 1 hour. This is an introduction. This is something that could take you, a couple of weeks of actually learning to grasp. But I can promise that when you do finally get it, it makes the biggest difference in your trading. So I would recommend don't freak out if you don't get it right away. I don't know if you have anything else you want to say, Sheen or Geo.
No, I'm good. Once again, as just a repeat, if you have any questions, we don't want to hold the Zoom too long. So if you have any questions, throw it in the Discord. We have me, Geo, always like going back and forth in there. If you haven't joined it, I'll just put a link here. I feel like everyone here has. We have so many people, but just in case.
All right, everybody. Yeah, if you need us, we're in the Discord. I know this went a little, we're like an hour on the dot. Perfect. It's Thursday. Everybody can go, enjoy your day. If you have any questions, let us know in the Discord. And if not, everybody have a great night.
Thank you everyone for joining.